The SERV Board Governance and Personnel Committee is now being recorded for record-keeping purposes. By participating in the session, you're consenting to the recording, retention, and future viewing of this meeting. This meeting is now being live-streamed.
Okay, welcome everybody. I am calling to order this Board Governance and Personnel Committee meeting of the SERS, April 28th, 2021 at approximately 1:12 p.m. I wish we had behind me, if you can see, cardboard cutouts like they have at the games, so we don't have an empty audience, but I know we have folks tuning in. With that, I think we need a roll call, and Katie, are you going to do that?
Yes, I will.
Okay.
Chairman Tillman?
Aye. Present.
Tucker Garrity?
I'm here.
Okay. Charles Duncan for Senator Hughes?
Here.
Mr. Thal?
Here.
And a representative from Secretary Biggs' office.
Here.
Is that Alan Flanagan?
No, it's Richard Day.
Oh, sorry, Secretary.
Okay, we have
present.
We have a quorum. The first bit of business is the approval of the minutes. A motion is in order to approve the minutes of February 23rd, 2021, Board Governance and Personnel Committee meeting. Do I hear a motion, please?
So moved.
I hear a motion. There's a second.
Second.
I hear a second. Anyone on the question? Hearing none. All in favor? Aye. Aye.
Aye.
Any opposed? No. Motion is carried. Back to the agenda. Old business, there is none. Special presentations, there are none. For new business, we have the SERS Fiduciary Review and Board Self-Assessment Final Report with Funston, and Chris Houston will lead up. Chris?
Yes, thank you, Chairman. Welcome, everyone. So if you go to Board Docs in Agenda Item 6A, you'll find a copy of the SERS Fiduciary Review and Board Self-Assessment Final Report, which is dated April 19, 2021. We're pleased that we have this report finalized and ready for your review and consideration. Today, we are pleased to have members of the Funston team here with us to review the report with you, to answer any questions that you may have. So what I'd like to do without further ado is to turn this over to Randy Miller and Rick Funston. And I just want to, before I have them start speaking, I just want to say that we had a tremendous relationship from a staff perspective in working with the Funston team in preparing this report, and I'd also like to thank the members of the board and the designees for your very, very welcome cooperation and assistance in this process. I know there's a lot of work in this, and we really do appreciate the time and effort that you put into it. So with that, I'll turn it over to Randy and to Rick.
Rick, are you there? I think Rick is going to kick it off. Are you on mute, Rick?
My apologies. I'm Rick Funston, and I'd like to echo what Chris was saying in terms of the support that we receive, both staff as well as the board, and we hope that this kind of reflects everyone's expectations. Just by way of background, I am the CEO of Funston Advisory Services, and we've focused almost exclusively on public retirement systems. Over the years, we've conducted many reviews such as this, as well as facilitated self-assessments. And as you'll see, we think that this is one of the more highly rated systems. And I think we've looked at a wide range of them, and obviously every system is different, including a review that we did 5 years ago with SERS itself. Before that, I was the National Practice Leader for Governance and Risk Oversight at Deloitte. With me today are Lisa Morris, John Lukomnik, William Flick-Fornia, and Randy Miller. And I'm going to ask each of them to give you a brief background of themselves before making each of their presentations so that we can get right into it. Could we go to the next slide, please? So, since our last review, it's apparent that the Service Board has made significant progress, and it should be commended for that progress. And I think it becomes evident in everything that we will be commenting on today. And even though the self-assessment was one of the higher rated self-assessments, the board still identified many opportunities for improvement, which is what you would expect. Typically, higher performing teams and organizations always identify further things that can be done to improve their performance. What we've also done is put this into an implementation roadmap that we've worked with staff to try and establish an order of priority and a sequence based on the degree of difficulty, the resources required, and the time, and so on. And then once the board has accepted the recommendations, and for those that it accepts, then obviously the board should work with the staff to monitor implementation and progress. The next slide, please. Today, what I'd like to cover with you is, first of all, at a high level, what are the review objectives? Sorry, can we have the next slide? Thank you. To cover what the objectives are and what the process was that we went through it, we're going to present in two parts. First part will be the governance review assessments led by each of the respective team members with respect to each of the areas shown. And then the second part will be the results of the board self-assessment with the overall ratings as well as your recommendations for improvement, and obviously with some refinements added by ourselves. And then we'll come back for a closing summary. The review objectives, if you go to the next slide, please. Really, again, twofold. One was to conduct a fiduciary and governance review of the board's performance of its duties in four main areas: non-economic investment requirements, the asset liability matching process, legislative positioning, and investment manager selection. And then secondly, to assist the board in its self-assessment and also to identify subject areas that may be appropriate for further education and training sessions. The next slide, please. In terms of the process, we began with an online survey. Then we conducted a series of interviews based on the results of those surveys. We got your feedback. We prepared a summary of the self-assessment results and distributed that. And those comments were distributed again prior to finalization. As you can see, I don't intend to read each of the points to you today, and we'll make the assumption to make the best use of your time that everyone's had the opportunity to review the report. And so we'll try to make the best use of your time by hitting some of the highlights and then opening it up for discussion or questions or clarification that you may have in respect to each of these areas. Any questions before we get into the actual presentation by the team members on the specific components of the report? Good. All right. Well, then I'd like to turn it over to John Lecumnick now. John, if you could perhaps give us a brief introduction of yourself and your background, and then talk about the non-economic investment requirements. Next slide, please. John?
I'd like to thank the board and the committee for the opportunity to do this. I am a long-time institutional investor. I ran the investments for the 5 New York City public pension funds in the mid-90s. Since then, I have reviewed the investment programs of public pension funds and sovereign wealth funds with aggregate assets of close to $1 trillion. I also sit on the board of a mutual fund, and I am on the Deloitte Audit Quality Advisory Committee, and recently finished a guest international visiting professor at Cambridge at the Judge Business School as a professor in the finance PhD program there. So we were, as you know, asked to review the so-called non-economic investment programs, and as Rick said, the report is detailed, so we're only going to hit the highlights. In general, we note that public pension funds often include programs to invest with emerging managers, diverse managers, and in-state managers and in-state investments. Among the motivations to do that are evidence that smaller and diverse managers can add economic value, to surface talent, which refreshes the industry while providing opportunities for traditionally overlooked populations, to establish relationships with high potential but less seasoned private market general managers, so have to have access to follow-on funds in future years, and for in-state programs to promote the economic health of the sponsoring jurisdiction, in this case the Commonwealth of Pennsylvania, to strengthen its ability of the sponsor to make future actuarially required contributions, as well as to improve the economy of the state. And of course, many funds with such programs, probably most, invest for multiple of those reasons. As with all investments, the fiduciary obligation of public pension fund trustees remain the same. That said, there are challenges. Emerging managers generally receive small allocations, creating a diseconomy of scale. A fund-of-funds structure, headed by a specialty manager of managers, solves this, but creates two layers of fees. Nonetheless, many funds do choose this route, as has SERS, for a number of reasons. The specialty manager of managers knows the space, provides investment and operational due diligence, and often mitigates the operational risk by providing business, operational, and marketing advice to emerging managers who may have investment skill but need business and infrastructure help. And of course, a fund-to-fund structure provides instant diversification. A different issue with the manager-manager structure involves alignment of interests around so-called graduation. Graduation is when an underlying manager in the fund-to-funds program proves itself over time and could be considered for a direct allocation. An underlying fund that's ready to graduate probably has performed well and is attracting inflows, and that means that the graduation removes a top performer from the fund-to-funds, which could create a misalignment of interest between the plan sponsor, which wants that, and the manager of managers, which will be losing a top performer. Let's move on to SERS specific. As Randy will show later, the overall scores on the self-assessment survey were very high. This was the only area that registered broad dissatisfaction by the board. The verbatim comments and in one-on-one interviews revealed three overarching desires. First, to do more. Second, to re-examine the criteria. And third, to make sure the fiduciary obligations continue to be met. So SERS in these three areas has one program and two what I would call policies. It has an emerging management program and specific policies, although not programs, on diversity and inclusion and on in-state investing. Both the program and the policies are crafted to be consistent with SERS fiduciary obligations. Let's talk about the emerging manager program first. As you know, SERS implemented an emerging manager program in 2019 with twin goals. First, to identify and gain access to talented investment managers in early stages to generate above benchmark returns, and two, to provide an evaluation platform of potential managers who have demonstrated superior risk-adjusted returns for consideration into the fund. That's the graduation issue I mentioned earlier. The program is run through two fund-to-funds, one in emerging market equities, one in international small-cap equities, and the asset class and sub-asset classes were chosen because SERS believes that relatively inefficient markets where active management reasonably can be expected to add value. All the underlying managers of the fund must meet a series of specified criteria designed to demonstrate compliance with fiduciary standards. I also note that there is a pre-existing manager fund-to-funds program in private equity run through Harbor Invest, which is in a mature state and run off and has not received new allocations the past few years. There is, however, in none of these programs any formal process in place to identify managers, underlying managers, which may be ready to graduate. Let's move on to diversity and inclusion. SERS encourages the use of diverse investment managers in all asset classes. consistent with the recommendations of the Public Pension Management and Asset Investment Review.
Can I interrupt you for a minute? We're not following, the slides aren't going with the presentation, are they?
There's no slides yet here. This is, the way the slide is working is this is the one slide that's a summary. The next two slides will be recommendations.
Okay.
So the slide sort of summarizes it.
All right, thank you.
My pleasure. The SIR's desire for diversity and inclusion has been communicated effectively to all the relevant investment consultants so that searches do start from a diverse pool of potential managers. As of December 31st, SIRS has 19 diverse managers on its rosters. The 4 public market firms manage a total of $766 million, and SIRS has committed a total of nearly $1.9 billion to the 15 private firms. SIRS standard due diligence questionnaire asks all prospective managers, whether a woman or minority-owned firm or not, about relevant policies, and asks general partners to complete a diversity and inclusion report, which provides various breakdowns by position. All due diligence packages presented to the board now include a SIRS diversity and inclusion template. If there is a formal diversity and inclusion policy for the manager, that policy is also included. Staff also details managerial workforce statistics, retention, mentoring, and other efforts, as well as policies on workplace harassment, family leave, mentorship, and outreach. Moving on to in-state. As SIRS submission, budget submission to the state legislature makes clear, SIRS follows what we call in all other things being equal philosophy regarding in-state investments. Where investment characteristics are equivalent, the board's current policy favors investments that have a positive impact on the economy of Pennsylvania, and that is defined as both in-state managers and in-state investments. There is not currently any dedicated allocation to that. One did exist in the past, but it was suspended because of difficulty in finding enough fiduciarily appropriate investment options. That said, SIRS investment staff does verbally discuss the desire for in-state investments consistent with producers. As of December 31st, SIRS owned $598 million of Pennsylvania investments, approximately 1.7% fund, in both public, private equity, and in fixed income and publicly traded. The numbers, as well as the diversity numbers, come from SIRS's annual budget submission. There is no separate disclosure or discussion about the Emerging Manager Program, which is run through 2 funds of funds. They're reported as a single line item and do not disclose the underlying investment managers. Also, despite the amount of reporting SIRS does in the budget submission, there's no standalone report on the Emerging Manager Program or on the diversity or in-state policies presented to the board or the public. As noted on this slide, and now we'll get back to the slides, we do think a few basic improvements could make the Emerging Manager Program and the diversity and the in-state policies more effective. Next slide, please. First, eliminate the use of non-economic as an adjective describing these programs. SIRS has identified economic reasons for the Emerging Manager Program. Moreover, the use of non-economic as an adjective immediately marginalizes these areas and could raise issues of fiduciary duty until someone looks into what's actually being done. Because in reality, SIRS is very cognizant of the fund's fiduciary obligations, and the crafting of the criteria for the Emerging Manager Program and the other 2 policies reflect that awareness. Second, the Investment Office should develop a standalone annual report to the board summarizing the past year with regard to the Emerging Manager Program and with regard to the Diversity Initiative and the In-State Investing Program. This will provide a central resource to the board, and in some ways, this is a way to utilize the what gets measured gets managed truism. The report should include a look-through to all underlying managers, including strategy, diversity status, in-state status, assets under management from SIRS, total assets under management, performance, and benchmark. Third, SIRS should just update its investment policy statement to reflect the still extant hard invested emerging management. This is simply a cleanup of the IPS. Next slide, please. We believe you can enlarge these programs, particularly the Emerging Manager Program, and you can be more effective. So the first thing on in-state is the investment office, working with the counsel's office and the investment consultants, should develop an informal information memorandum as part of the side letters for all new partnerships explaining CSR's position with regard to in-state investments. While the GPs are told verbally, including that information in a standard side letter package given to all general partnerships can't hurt. And like much of CSR's own policies, it could help in a GP's decision on where to invest, quote, all other things being equal. We also think CSRs can expand the formal emerging manager program to other asset classes beyond public equity. Part of the idea is to graduate and get access. That would suggest some private asset classes. And there clearly are fund-to-funds available in fixed income and potentially also in real estate. Finally, we believe CSR's investment office should design a program to monitor the underlying funds within the emerging manager fund-to-funds so as to judge the potential of graduation. That is a great part of CSR's explicit rationale for the emerging manager program and holds great economic promise to offset the second level of fees charged by managers and managers. I thank you. With that, I would stop to answer any questions now or take them later, as you wish, Mr. Chairman.
Does anyone have any questions right now? No? Okay, continue on.
Great. I will turn it over to Flip Fornia, who will discuss the asset and liability matching process.
Yeah, thank you, John, and thank you, Mr. Chairman, and SIRS and your staff. Let's go to, oh good, we're on slide 9. Before we get started, so I'm the actuary of the group. I'm a fully credentialed actuary, a fellow of the Society of Actuaries, and I was elected to their board, re-elected last year. I happen to be the Secretary-Treasurer of the Society of Actuaries. And I started my own firm, Pension Trustee Advisors, about 11 years ago. And so I do a lot of these kinds of one-off special projects. I've worked for dozens of retirement systems around the country, and as well as I work for other entities, like the state of Ohio is my largest client. I work for their Oversight board. And then I work for labor, I work for third parties. I was an expert witness in the Detroit bankruptcy, for example, working for the Coalition of European Banks. Now, this subject is one of my favorite subjects, asset liability matching. I've spoken on it several times, and I've been kind of in the loop for about 10 or 15 years since it really got started. And the basic concept is that a pension fund or a pension program is a stream of payments out to members that when they're retired. And an investment portfolio can also be thought of as a stream of payments. And so asset liability matching, in its pure sense, it completely aligns assets with the cash flows from the assets with the cash flows of the liabilities. And the great thing about it is that then interest rate sensitivity goes away. In insurance, in banking, with annuities, in a lot of economic arrangements, asset liability matching is essential and makes perfect sense. But in the public pension community, especially in the U.S. public pension community, it just really isn't done very much. You guys are beginning to incorporate this concept somewhat in your investment policy. Now, what pension systems do is, unfortunately, it's also ALM. It's asset liability modeling. It's a product, or not a product. It's a process where you look at potential investment returns, potential discount rates, potential inflation rates, and you do some kind of modeling. Usually, it's stochastic with thousands and thousands of iterations of what might happen out in the future. And when you do that, and most major pension systems your size do this kind of work. You do it occasionally. It's usually done by the actuaries. And what it does is it kind of stress tests what might happen to your liabilities or your contribution rates or your solvency or your funded ratios or whatever is important to you. It models that out based on potential different investment returns. This is somewhat consistent with what you all are doing, but asset liability matching, as you're doing, is somewhat different. Let's go to the next slide, please, slide 10. So basically, there are a spectrum of approaches that can be done with respect to asset liability matching. Alternative one would be to abandon it and have no emphasis on asset liability matching, but use a conventional practice of asset liability modeling. That's pretty much what most other public pensions do. Let me jump to the other extreme. Alternative 4 is to go all in, to eventually try to get your portfolio to be 100% bonds that precisely match the anticipated benefit payouts. That's also known as liability-driven investing, where all your investment strategy is driven by your liabilities. To get there would be expensive. It would be a gradual shift from equities to bonds. This is the approach that's done by insurance companies. Typically, it's required. It's done by banks, and it's done occasionally by private sector pensions that are kind of in a wind-up mode. So those are the two extremes. What we see, the two more realistic alternatives are the in-betweens. Alternative 2 would be to kind of de-emphasize the matching part of what you're doing and build in more of a modeling process. You'd continue to do a little bit of asset liability matching, and you define some specific objectives, but you would not have it the centerpiece of your investment strategies. And then alternative 3, which is pretty much what we're going to recommend or are recommending, is you continue to put what I'm calling a toe in the water with respect to asset liability matching. And as practical, you might move towards a more robust liability-driven investing or a higher bond allocation. But realizing that it's not likely you would move completely there unless interest rates change or somehow your funded status improves dramatically. And then, if necessary, so the basic challenge of matching is that you're trying to match a stream of income with a stream of outflow. Now, fixed income is fixed, and so that's easy. But equities are not fixed income. So equities, you don't know what your income stream is going to be. So therefore, if you want to have a full liability-driven investing or full asset liability matching, you can't really invest in equities. So if a pension fund doesn't invest in equities, then its expected rate of return is necessarily going to be lower. So the alternative 3 and 4 tend to be more expensive, assuming equities outperform fixed income, than the other alternatives. Let's go to slide 11, please, for just a summary of our recommendations. First of all, keep doing what you're doing in terms of education. Your CIO has done, there's a piece of asset liability matching in almost every month's board meeting, and I think that's essential to continue doing that. And then our second recommendation is that start to develop more what your end game is. That was one thing that we discovered is I don't think there's a consistent consensus on what your end game is. What are you trying to do with asset liability matching? You've done a bunch of little things. You've got some incremental changes in your bond portfolio, which frees yourself up to take more risk on the equity side. So you're doing a few things already, but our recommendation is that you really robustly try to define what your end game is. And with that, let's go to the slide 12. Which is once you figure out what you want your end game to be, develop some specific milestones on how you're going to get there. Maybe it'll be dependent on interest rate environment, maybe it'll be dependent on funding levels or whatnot. Then our number 4 recommendation is that once you're doing that, figure out what the cost implications would be of that and communicate them to your constituents. And then you kind of test drive it with your asset liability modeling approach, which you do in conjunction with your actuaries and or your investment consultants. And then assuming that you don't intend to ever go full bonds, our 6th suggestion is, make that clear. Make that clear that you're doing this to help match the liabilities and the assets in the short run and the long run, but you'll never intend to completely get there. And that really summarizes our findings and suggestions. And as with John, I'm happy to take questions now, Mr. Chairman, or we could wait till later.
Anybody have questions for now? Continue on.
All right. Well, in that case, let me turn it over to Lisa.
Thank you, Flick. Moving to slide 13, thank you. I'm Lisa Morris. I've been with Funston for going on 5 years. Prior to that, I was the executive director of the School Employees Retirement Fund in Ohio. It's been a pleasure reviewing this. It matches with what I did as executive director. Prior to working for the pension fund, I held some senior leadership positions in the state, clean water director. And prior to that, I was the chief mining regulator for all mineral and coal mining and mine safety. And as my beginning career, I was a litigator, but I found that the intersection of public policy and leadership and working in the public sector was where I wanted to be. And I still continue working in that area. It was a pleasure working on this engagement. I only have a couple of slides. This is the most straightforward of the review components of this engagement. And I'm not going to read the slides. I assume that you have gone over them. But as background, there is a little bit of direction in your retirement code as to what the responsibilities of the ED are in regards to legislative positioning. Both it's mostly reactive and support for the legislation, drafting cost analyses and things like that. And as you know, you have no other policy or additional guidance on that. I do want to say something at the start that I want to end with, and that is that SERS is extremely well positioned right now to engage around where you want to be with legislative positioning. And I say that because the board, the executive director, and your staff who work on legislation have positioned SERS extremely well. You're a go-to for information. You're known to be timely, responsive. They trust your information. You are exactly where pension funds need to be in working on legislative issues. So that's a great place to start. There's nothing really broken here, but we think you have some opportunities. There is one thing to point out, in that you're very unusual, in that a majority of your trustee positions are filled by elected officials or ex officio appointments to the board, and that I would say adds a degree of complexity to your conversations around legislation. So that may be the one dynamic that will make your conversations a little more lengthy. Differences of opinion, which are not bad, but you need to reconcile those in order to provide perhaps some more infrastructure for your executive director in the moment in the halls of the legislature. Next slide, please. There are some approaches that you can consider. Again, there's nothing broken here. And you're in a great place to consider these options. Alternative one, status quo. You don't really need to do anything. Some of you expressed there's no need for a formal board policy on legislative positioning. A few of you said it would be nice to have. But there is no real imperative. You have the time to review this because you're in a very, very good respected position. Alternative two, you can develop a new board policy on legislative positioning. Now, understanding that SERS is closely connected with legislative and executive, the budget is controlled not by your board, but by someone else in state government. So you have some very close relationships there that you need to walk through carefully. But that doesn't mean you can't have a position on legislative positioning. Some boards don't even have a written policy because they think it's fundamental that you would speak up opposing anything that in any way challenges the sustainability or the funding of your pension fund. As trustees, of course, you work in the best interest of the fund and its beneficiaries when you're sitting in your board chair or board position. You could also add to that policy that you conversely would not support those things that threaten the viability or the sustainability of the fund. There are a variety of ways that you could define a little bit more of your position on legislation, should you so choose. Or you could, in alternative 3, expand the responsibilities of the executive director and add more definition to what you expect of the executive director in regard to legislation. Next slide, please. This all leads to the recommendation that the first conversation that we think the board should have is around the role that you expect the executive director to play in representing your fund. As I said, in the moment, you're grabbed in the hall, you have questions over the weekend, what do you think the board would think of this, or would the board support something like that? And I know in your situation, your executive director stays in good, close contact with your board chair, and there is open and transparent dialogue around how to be reactive in the moment. But I think that's the first step. You decide what you expect of the executive director, and you decide what direction you would like to go in pursuing the options on the previous slide. And again, to wrap this up, you're in a great position to do this. Nothing is terribly broken. You have great relationships and you're well respected. You have the opportunity to build on that should you so choose. Mr. Chairman, I'm glad to take questions now or again at your direction.
Does anybody have any questions? Okay, let's continue on.
Next slide, please. I guess I am back on. So we were asked.
Thank you. John, can you go to the next one? Yes.
We were asked as one of the 4 requirements to look at investor manager selection, due diligence, monitoring, and termination from the board's point of view. We'll say that in general, the board is very satisfied with the current process, though open to improvements, and particularly around efficiency issues. The due diligence packages presented to the board are at an appropriate level of documented information and analysis to allow the board to make informed decisions. There are internal office policies and procedures that are adequate to support those diligence packages. There is some concern that firms languish on the watch list for longer than the stated 12-month maximum. The general feeling is one of satisfaction, and in fact, SIRS, the biggest issue is delegation. How much should be delegated to the staff? How much should be kept at the board? SIRS recently took a step towards delegation, allowing the CIO to select passive public equity managers. Our interviews show that's been well received by both staff and board members. We will say that SIRS is a little bit of an outlier. 55% of its public plan peers delegate investment manager selection to staff. Even then, there are constraints. For instance, no new asset classes without the board's approval, no new types of investments, sometimes a dollar cap, and other things which are detailed in the report. And we also note that peer funds which delegate tend to have strong governance practices and checks and balances specifically around manager selection. As an example, SERS already utilize many of those, but there are a couple of things that it would not be unreasonable for the board to require additional provisions in place. The report details 10 additional checks and balances, the most important one of which we believe is creating a formal internal investment committee, which would have investment officers, but also a non-investment office person in there. Generally, it's the general counsel or the CFO as a way of understanding operational risk issues. We also would suggest some enhanced risk modeling for each investment and various reporting to the board and the investment committee, as well as obviously the concurrence of the appropriate investment consultant. Next slide, please. Delegation is controversial. I know it is not common in Pennsylvania, even though, as I said, 55% of your peer funds do it. And so we developed a range of policy options. There's also a 5-part rationale for why peers are delegating. But as with the other policy options, these range from the least you can do to the least you can do to the most you can do. And let me just run through them a little bit. I seem to have lost my last one. So you can continue the status quo, and you can continue to listen to manager presentations. One thing I will say is that even peer funds which retain manager discretion at the board level generally do not listen to manager presentations. There's a reason for that. Managers have a statement among themselves that say those with the best marketers win. Often there are investment specialists, portfolio consultants, etc., that come in and do it, and it creates a behavioral wild card atop the due diligence process. You could, for that reason, continue to approve all new managers, but not have the manager presentations. You could grant authority to the CIO to select follow-on funds in private asset classes. These are investments in with GPs in a fund following a fund which you have successfully already invested in. Again, there would be conditionalities around there, such as no major change to the partnership, no major change to structure, no major change in terms and conditions. What is the step up? In other words, are we happy with 125% of the last fund's commitment, 200%, 100%? All those would be conditionalities around that. You can grant authority to the CIO to select active managers in public asset classes. This is an extension of what you did on passive, on the assumption that since the CIO will be bringing the active any decisions to the next meeting of the board, and since public asset classes are by definition liquid, it can be reversed in an emergency. But basically, the due diligence process, again, with the concurrence of the consultant, works, and so you can extend that authority, or you could go all the way and delegate all managerial and general partnership selection to the investment office, subject to the policy concerns and constraints that the board would initiate. Next slide, please. So the main thing we would like you to do is to debate that and to discuss what would make board meetings more efficient and investment more efficient. Our recommendation would be the alternative 4, which is don't listen to the manager presentations, allow delegation for follow-on funds and public equity, but not yet for all private asset classes until some of the increased checks and balances, which we outlined in the report, are granted. There are a couple of other recommendations we make. As I said, there are policies and procedures in place. Those were last reviewed in 2018. Generally, we would recommend them be reviewed on a 2 to 3 year cycle anyway, but for SIRS in particular, given the turnover, that's 2 CIOs ago, and it would be appropriate for the investment office to review them. Second, on rebalancing, you allow the CIO to rebalance, but the policy is that such actions have to be first reported, first approved by the investment committee and the chair of the board. And we view these as a totally mechanical or tactical process designed to implement the board's asset allocation. It's not a strategic decision, and we think the other constraints contained within the rebalancing policy, both the tolerances and the requirement to report immediately thereafter, provide adequate control in the structure of the process. Consulting with the 2 chairs prior to implementing rebalancing, we do not believe it is likely to add value. It just adds complexity. Obviously, the staff should endeavor to meet the 12-month standard for removing managers from the investment manager evaluation list, which they agree with. Next slide, please. The investment policy statement should be updated to reflect the recent decision as to public equity passive managers. It's just a matter of appropriate documentation. And the final 2 recommendations directly relate to the policy options that I discussed on delegation, both the level of delegation and whatever you do, things are moving targets. And we suggest that you revisit the level of delegation, including how well it has worked and trends among peers and other leading practices at least once every 3 years. And again, Mr. Chairman, I'd be glad to take questions.
Any questions on the floor? Hearing none, let's continue.
Okay, so I'm Randy Miller. If we could have the next slide, please. I'll go through the Part 2 board self-assessment. Just briefly, I've been working with Rick Funston for the last 11 years, working with public retirement systems and governance and strategy operations and risk. That's pretty much all we do. Prior to that, I was a strategy and operations partner with Deloitte for 27 years. One of the things I do is lead our efforts around public retirement system benchmarking, which we find it to be an important part of these reviews. Just to remind you, the scope of what we looked at in terms of self-assessment encompassed the 10 areas listed here: governance structure, the bylaws and charters and policies, the powers reserved for the board and the delegations, board meetings and operations, reporting and board oversight, the committees, education and development, interactions with staff, the evaluation process for the board direct reports, and then also the role of external advisors. So it's a pretty complete list. We've got quite a few recommendations in here. I'm going to try to hit the highlights, and recognizing that we are, from an agenda standpoint, approaching the end of our time slot. I'll try to go through and let you ask questions wherever you have them. If we could just go to the next slide, though, I want to just kind of give you an overall context for what we saw from your self-assessment process, where with the survey process, we asked for ratings from the trustees, the designees, and the executive team for each of these 10 areas. And I think we have to say these were, on average, the highest ratings that we have seen. They're quite well regarded by all 3 groups. Nothing rated lower than effective. Everything was on average between effective and very effective. So you can see just from the numbers here, there were not areas where there were burning platforms, areas of red flags. We've got to address these things. Having said that, as Rick mentioned earlier, there were 30 improvement opportunities identified. If we can go on to the next slide, please. And there also were, I don't mean to say no one had any critical comments, because there were criticisms in some areas, but having said that, on average, they were generally quite positive. What we've seen is that there's been quite a bit of improvement over the last 5 years. I was part of the team from Funston 5 years ago that was involved, and I think we can say from a first-hand perspective, we've seen a lot of improvements in the governance, a lot of improvement in the policies, and I think that's reflected in the comments we heard from everyone as well. There's a high level of confidence among the board. The education program, while there were recommendations, it was felt that it's meeting the needs of most of the trustees. The relationships are considered to be very good. I think we consistently heard the board feels that at this point in time there have been a lot of positive developments in terms of the executive team, that it's better and more stable than CERS has had in quite a while. And on that basis, the improvement opportunities are really kind of continuing improvement rather than fixing problems that are there. Before I go into each of the areas and try to quickly go through them, Mr. Chair, or anyone else, any questions?
Anybody have questions? Seeing none, continue.
Okay. Next slide, please. So the first area was governance structure, and I will not go through each one of these in detail. There were a number of areas generally related to autonomy that we think the board should make some recommendations to the General Assembly. A couple of those, having staggered terms to improve continuity on the board, and requesting that one or more of the appointed trustees have professional investing experience, probably would be kind of a couple of the easier things to request in the legislature. We're also making a recommendation that you have 2-year terms for your board and committee officer positions, and that you consider term limits of 3 terms, just in order to not have burnout for the chairs, in that you have some kind of fresh thoughts. So that we find that that's generally considered to be leading practices with boards in general. And I guess at any time, please ask questions, because I'm going to try to go through these all relatively quickly under the assumption that everyone's read them and we haven't had objections or feedback on any of them.
Hold on, the treasurer has a question. Treasurer?
Thanks. I think I know the answer to this, but under your term limits, that's not for the seats themselves, correct? That's just for the board and committee chairpersons?
That's correct.
Okay, thank you.
Okay.
Okay. No other questions? We'll go on to the next slide, please. So actually, in the bylaws, charters, and policies, there were no specific recommendations there. The next area, the powers reserved and delegations, I think we've pretty well covered with what John Lakomnik went through regarding the investment decision-making. And there's quite a bit of detail in our final report on this that we won't try to go through with you today. Could we have the next slide, please? In terms of board meetings and operations, there were a number of recommendations here. I think we heard from you. Again, these are primarily what we heard from you, kind of synthesized with our experience and what we've seen at other systems. But to try to get the board oriented to spend more time on the strategic issues, both around investments and on the effectiveness of the overall organization, as well as on oversight of the entire organization. If we go to the next, we have some more in this area in the next slide as well. Excuse me, okay. And then in terms of oversight and independent reassurance, to streamline reporting to the board, this is something that many systems struggle with, and many boards and trustees struggle with, getting large board packages. And we find that it is much more helpful when there are dashboards and ways to be able to drill down into the details, but not require you to get to the details in order to understand how an area is performing. Another area of importance, increasing importance, is cybersecurity, and to make sure that the board is actively overseeing cybersecurity. This is an area that historically kind of wasn't there, and it needs to be included, typically under the auspices of one of the committees, often the Audit Committee. Next slide, please. In the committees specifically, there was some suggestion that it's kind of your board meetings and committee meetings today are really an intensive couple-of-day period typically, and that it would be worthwhile considering having at least some of the committee meetings in between board meetings, and the recognition that particularly with the current virtual environment, and if you do continue to have at least some meetings virtually, that they might be good candidates for doing that, which would give both more time for follow-up on anything that was required coming out of the committee, and also preparation for the presentation to the board. Also, focusing in on 6.4, to also have a process where, at least annually, that the committee chairs work with the board chair and their committees to identify what should the agenda be for the upcoming year, and have a pretty good sense of when the key decisions are coming up. And if we could go to the next slide, please. Related to that, okay, I'm sorry, I was just going to say related to that in 6.5.
We have a question. Hold on, please. Mary Soderberg?
Okay.
Yes, just a very quick question. When you say an ad hoc committee, what kind of a committee are you referring to?
The joint committees that you've had with, maybe could we go back one slide, please? I think you're talking about 6.3. It's quite unusual to have ad hoc committees that have staff members as voting members, and we're suggesting that if you do form ad hoc committees to address a particular topic, that only the board members should be voting members. Of course, staff should support them, play the same role that they're playing, but not be considered to be voting members of the committee.
And so what are your examples of ad hoc committees?
I'm not sure that I know of one recently. This was brought up again. This was coming out of the self-assessment. Okay. It was a suggestion. Okay. It may be that in last couple of years you haven't really had ad hoc committees.
Okay. All right. Thank you.
Okay. Could we have the next slide, please? So again, at 6.5, the having a policy priority, again, this ties back into the prior one at 6.4 that we're talking about, that the having an agenda for each committee for each year that feeds into the board's overall strategic agenda and questions, and then ultimately also feeds into the continuing education program and the topics that the board needs to have refreshers on. We find that's the most effective way to integrate the continuing education into the strategic agenda, and making sure that there's adequate time for each of the key decisions to receive the discussion and consideration and input, and not be up against hard deadlines without being prepared. Next slide, please. So board education and development, this was also an area that was explicitly spelled out. We recommend you have an overall continuing education plan that would be comprised of a core curriculum that everyone would need to know and have refreshers on every couple of years, that would be tied to that strategic agenda and the timing of the decisions, but then would also be supplemented with individual tailored plans for each individual trustee and designee, and that there would be a curated list. We heard the comment that there are a lot of opportunities, but I don't know how to differentiate among them, so that there would be maybe a little bit more of a recommended list with maybe some other possibilities, but the ones that would be recommended, and it would be tied to the needs that were identified by each individual trustee or designee. And then also the areas that were identified for more continuing education opportunities were some of the basic investment fundamentals, actuarial fundamentals, and particularly for the newer trustees, and then investments again and actuarial matters, they kept coming up, as well as fiduciary responsibilities, parliamentary procedures, leadership, and so forth. If no questions, the next slide, please. In terms of board interactions with staff, this was considered to be a very effective area. The most important area here, I mentioned earlier that we heard quite a number of comments that the board feels quite satisfied that you've now got a strong management team in place, that now's the time to really take a look at succession planning for the board's direct reports to make sure that the bench strength is there and that you have good continuity going forward in the future. Next slide, please. In terms of the evaluation of the direct reports, I think the biggest recommendation here is to do more on the goal setting side at the front end as opposed to the evaluation at the back end, so that there's a collaborative process with the executive director, for example, that would, at the beginning of each year, focus on what are the annual goals specifically for this year, in addition to the normal kind of evergreen annual evaluation factors, and then also to try to link the compensation to the achievement of those goals to the extent permitted. And we recognize there may be some limitations there. Go to the next slide, please. Finally, in the area of external advisors, again, there was a pretty high level of satisfaction here. It was a little lower than some of the other areas. But I think the most important recommendations here are to have the board meet with the each of the board's advisors. If possible, in executive session, we recognize there may be some restrictions there, but in any case, without staff present, to make sure that you're getting the opportunity to ask the advisors questions, make sure that they're not being unduly influenced, to give them feedback, and then that's really 10.2, is to have performance feedback to them annually, the way you would expect to have with a direct report to the board. We often see that advisors actually want that feedback, and it helps them to do a better job, but sometimes they don't get it, and they find out at the next RFP process that you really weren't as happy with them as you thought. But you can give them that feedback, and they will respond if you give that to them. And that's usually a very important way to get more out of your external advisors. With that, are there any questions overall on the self-assessment process before turning it back to Rick?
I'm seeing none. Let's go ahead.
Okay. Next slide,
please. All right. Thank you. Thank you. Yes, the last slide, please. I'm just repeating what I said at the beginning, which there's been a lot of progress. You've still identified things that you can do better. There will be an implementation roadmap, or there is an implementation roadmap to guide its implementation for those recommendations you decide to accept. And again, the board just needs to understand what that process is and monitor progress. And so we'll stop there. That concludes our presentation. And Mr. Chairman, if there's any further questions.
I appreciate you being cognizant of time. You're right on the spot for that hour. Unless anybody has any questions, I think dealing with Funston before with the governance project, I think you bring a lot to the table with your staff who have, experience all over the place. And I'm glad to see we excel in some areas. We're very unique. But also there's some areas where we can, look at maybe changes. And I think what we want to do is have this go into committees at this point. But before I roll that up, Chris, do you want to sum up here?
Yeah, I think, again, thanks. Rick.
Hold on, Chris. We have a question. The treasurer?
I think you answered it. I was going to ask what the process is for deciding when there were different alternatives of recommendations. I guess you're saying it goes to committees and we take it from there?
Right. That's the plan, Treasurer, is to have staff engage with the appropriate standing committees. We'll take a look at the recommendations and then run those recommendations through the committee process for then taking it to the board.
Okay, thanks.
Mm-hmm.
Any other questions? Chris, are you done?
Yeah, I'm sorry. That was it. Again, I'd like to thank Rick and Randy and the rest of the Funston team. Again, it was a pleasure working with you, and I'm sure if we have any follow-up questions, you'll be around to answer them by staff or the board. Thank you.
Okay.
Absolutely. And if I just may say and comment on behalf of our team, thank you very much for the opportunity to working with you. It's always a pleasure to work with a high-performing system and a high-performing board. And we wish you all the best in the future. And again, thanks once more for the opportunity to work with you.
Thank you very much. With that, I do have a motion, and it does reflect basically what Chris had just answered the treasurer's question. So, motion is in order that the Board Governance and Personnel Committee recommend that the State Employees Retirement Board, 1, accept Funston Advisory Services, LLC's SERS Fiduciary Review and Self-Assessment Final Report, dated April 19th, 2021, as set forth in the attachment, and 2, direct staff to engage with the appropriate standing committees to A, review the final report's recommendations, and B, make recommendations to the board for action as appropriate. Do I have someone making a motion, please?
So moved.
I hear a motion. Do I hear a second?
Second.
I hear a second. Can we have a roll call, please?
Chair Philman,
Aye.
Treasurer Garrity,
Aye.
Mr. Duncan for Senator Hughes,
Aye.
Mr. Thal,
Aye.
and Secretary Vig.
Yes.
All ayes.
Thank you very much, everybody. A very good report, and we still have a lot of work to do once we get those to the committees and then make recommendations to the board. So thank you very much. Back to the agenda. There are no comments, concerns, and questions unless someone has something to bring up.
Yeah, I do.
Go ahead.
Mr. Chairman, I have 2 items that I would like for to bring forward in this committee.
Go ahead.
Well, the first is just an update on the executive director search.
We will be,
is
Secretary, for your first question, we will be dealing with that in executive session in the board meeting.
Okay, great. And then secondly, I have questions regarding schedule flexibility for employees. It's obviously a big issue that has come up before this group, and in doing some discussing this item with some folks, seems like that it's an issue that's might be a little bit more broad than we thought. And I'd like to suggest that this committee look into it and consider the current policy in light of other policies around the state, and really just get into the issue.
I have no problem reviewing the policy, and if it needs to be tweaked, it can be tweaked. But we'll work on that, sir.
I really appreciate it.
Okay.
If I could just ask a question, by schedule flexibility, Secretary, what are you referring to?
That very thing. I'm talking about employees' ability to have schedule flexibility. And,
You mean in their scheduled work times, you're meaning?
that's right.
Okay, all right, thank you.
Okay, anybody else? Seeing none, motion to adjourn is in order. Could I hear a motion?
So moved.
A second?
Second.
I hear a second. Anyone a question? Hearing none. All in favor, aye? Aye.
Aye.
All opposed, no? Motion carried.